What began as a currency collapse then is becoming a world problem now. It started small, a single currency losing its footing, a single market buckling under pressure. But contagion never stays local. Within months, in 1997, the cracks jumped from one nation to another, then across oceans, exposing the weakness of a global system built on borrowed dollars and fragile confidence. Today, the pattern is returning. A world drowning in dollar-denominated debt, emerging markets squeezed by rising US rates, governments struggling to defend collapsing currencies, investors pulling out before the wave hits. The last time this structure unraveled, it took down economies that looked stable until they weren't. Now the same signals are flashing again, only bigger, only louder, and this time the whole world is exposed. What began as a currency collapse in one corner of the world is now resurfacing as a global pattern. And to understand why, we need to step back from the headlines and look at the foundation of the system itself, because crises do not start with panic. They start with structure, with quiet pressure building in places most people never watch. The modern financial world is anchored to the dollar, not by treaty, not by design, but by dependence. Emerging markets borrow in dollars because local currencies are too unstable. Banks finance growth with dollar loans because global investors demand it. Governments stack obligations in a currency they cannot print. It works in good years. It suffocates in bad ones. This is the hidden tension beneath every global cycle. When the dollar is cheap and abundant, capital flows freely. Nations grow, markets rise. Borrowing feels effortless, but when the dollar strengthens, everything reverses. Debt becomes heavier. Imports become more expensive. Reserves drain faster. Stability begins to bend. That is the cycle the world is entering again. Rising interest rates in the United States, a dollar climbing against dozens of currencies, emerging markets struggling to defend their exchange rates, investors pulling back and chasing safety. The same mechanics that once triggered a regional disaster are now tightening around an interconnected planet. In 1997, one country faltered first. Today, several are already under strain. Countries cutting spending to slow the bleeding. Nations raising rates to defend their currencies. Bond markets pricing fear instead of optimism. Banks holding exposures that shift from manageable to dangerous, with each tick higher in the dollar. This part sets the stage for everything that follows. The world is not experiencing isolated trouble. It is witnessing the early movements of a system that reacts the same way whenever one force rises too fast. The last time this pattern appeared, it consumed a region. This time the architecture reaches far beyond it. The deeper diagnosis starts here, where the currency of one nation becomes the pressure point of the entire world. The crisis of 1997 did not begin with chaos. It began with confidence, a region growing at remarkable speed, foreign investment pouring in, real estate booming, stock markets climbing, currencies tied tightly to the dollar to project stability. The illusion was simple. If the peg held, the growth would continue forever. But illusions break quietly before they break violently. The first fracture appeared when one country could no longer defend its currency. Reserves drained faster than officials expected. Traders detected weakness and attacked the peg. Government promises collided with market pressure. And then the line snapped. The currency dropped. The confidence dropped faster. That single break rewired the psychology of the entire region. Investors realized something they had ignored for years. If one country was vulnerable, others might be too. Capital does not wait for certainty. It escapes at the first hint of risk. Money fled across borders at a speed that made the crisis unstoppable. Visualize the sequence. Banks holding debt in dollars, watching their repayment costs explode overnight. Corporations with foreign loans discovering that their balance sheets no longer made sense. Real estate markets collapsing as credit evaporated. Governments forced to raise rates so aggressively that growth shattered on impact. Emergency meetings followed. Financial rescues were negotiated. Currencies spiraled. Stock markets lost decades of progress in weeks. A regional boom turned into a regional implosion. But beneath the headlines was a deeper truth. The crisis did not spread because countries copied each other. It spread because they were built on the same structure: dollar debt, fragile pegs, hot money inflows, liquidity that vanished the moment fear appeared. Contagion followed the architecture, not the map. The lesson was clear. A local currency failure can become a regional disaster when nations rely on the same funding source and the same illusion of stability. And that lesson is returning now, not as memory, as blueprint. 3 decades have passed since the Asian crisis, yet the present moment feels uncomfortably familiar. The world is watching the same signals reappear, not in one region, but across dozens of countries at once. Rising interest rates, dollar strength tightening like a vice, currencies losing ground faster than governments can respond, debt burdens swelling with every new tick on the chart. For years, cheap money created a cushion. Nations borrowed easily. Banks expanded credit without fear. Investors treated emerging markets as destinations for fast growth and guaranteed returns. The dollar was low. Liquidity was abundant. The risk felt theoretical. That period is over. Today, the system behaves like a stretched rope. Each rise in the dollar pulls harder on countries that relied on external funding. Governments burn reserves to defend their currencies. Central banks raise rates aggressively, not because their economies are strong, but because they are trying to survive. Corporations with dollar loans watch their repayment costs rise to levels they cannot support. Banks face maturity schedules that no longer fit their balance sheets. The signals began quietly. A currency sliding a few percent, a bond auction failing to attract investors, a spike in yields that looked temporary. But quiet signals accumulate. And with every new data point, the pattern becomes harder to ignore. The symptoms of a regional crisis are now visible across continents. This is not panic, it is mechanics. Dollar debt expands when the dollar is weak. It contracts brutally when the dollar strengthens. Every cycle repeats the same story because the structure has not changed. The global economy depends on a currency that serves one nation first and everyone else second. The question is no longer whether the pressure is building. It is where the break will appear. Because the early signs do not point to a single country under strain. They point to a global system shifting under the same forces that once triggered a historic collapse. And this time, the consequences will not be limited to one region. They will move along the financial channels that connect the entire world. Every financial system has a limit, a moment when quiet stress stops being absorbed and begins to reshape the structure itself. The global economy is approaching that moment again, not with headlines, with pressure, with the slow tightening of conditions that once triggered some of the fastest contagion events in history. The first strain appears in currencies. Nations defending their exchange rates are burning through reserves at speeds they cannot sustain. Each intervention buys time, not safety. A government can fight markets for a while, but no country can outlast a rising dollar forever. As reserves thin, confidence thins with them. A currency does not need to collapse to create fear. It only needs to look vulnerable. Then the pressure reaches banks and corporations. They hold billions in dollar loans that become heavier every week. What was manageable at one exchange rate becomes unmanageable at another. Refinancing turns from routine to impossible. A bank does not need to fail to trigger damage. It only needs to face doubts about its ability to roll over foreign debt. Doubt spreads faster than default. Governments feel the next layer of strain. Higher interest costs squeeze budgets already stretched by years of borrowing. Each rate hike forces painful choices. Cuts to spending, cuts to subsidies, cuts to essential programs. Austerity does not begin as policy. It begins as necessity, and the social pressure builds long before the numbers force official announcements. In this environment, a small shock can trigger an outsized reaction. A currency downgrade, a missed repayment, a failed bond auction, a liquidity mismatch inside a single institution. None of these events cause a crisis on their own, but each one pushes the system closer to the edge. Each one tests the belief that the structure will hold. The frightening truth is simple. The weak points are no longer isolated. They are linked. A failure in one country raises borrowing costs in the next. A bank under pressure spreads volatility to markets that seem unrelated. Contagion follows the financial plumbing, not the political map. The pressure point is not in one region this time. It is in the architecture that connects them. The moment where stress in the dollar system becomes stress everywhere else. And once that moment begins, the sequence is no longer linear. It accelerates. If the pressures building today follow the same trajectory as the crisis of 1997, the consequences will not be contained. They will travel through every financial channel built over the last 3 decades. Because the modern economy is not a collection of isolated markets. It is a network. And networks amplify stress long before anyone recognizes the pattern. The first impact hits sovereign balance sheets. Countries built on fragile currencies and heavy foreign debt are pushed toward restructuring. Their bonds fall. Their borrowing costs rise. Investors flee. Stability evaporates at the exact moment it is needed most. Then the pressure moves into banks. Institutions holding dollar liabilities discover that the price of survival has changed overnight. Liquidity drains, collateral weakens, interbank trust thins. A system that depends on confidence begins to behave like a system that expects failure. And when banks hesitate to lend to each other, the entire financial cycle slows. Corporations feel the next shock. Rising repayment costs crush profits. Expansion halts. Layoffs begin. Credit lines tighten or disappear. What was once a currency issue becomes an employment issue, a growth issue, a political issue. Debt is not an abstract number. It is a chain that connects markets to real lives. From there, the pressure radiates outward. Commodity markets destabilize. Currencies swing violently. Capital flows reverse across continents. A crisis that began in emerging markets reaches developed ones through weakened banks, shrinking demand and collapsing trade. But even now, the story is not only collapse, it is recalibration. The Asian crisis forced countries to strengthen reserves, modernize banking and redesign policy. This crisis, if it unfolds, will do the same. Weak structures will break. Stronger ones will adapt. The system will emerge changed, not erased. Because global cycles do not end with destruction. They end with clarity. They reveal which foundations were solid and which were illusions. They teach the same lesson every generation tries to avoid. A world built on borrowed currency and borrowed confidence will always face the same reckoning when those currents shift. The signals are here. The pattern is returning. And the consequences will not stay in one region this time. They will follow the architecture that binds the world together. If this gave you a new perspective, do not just scroll away, hit subscribe. This is Economic Chronicles, where history exposes the present and the future is written in the lessons we refuse to learn.